Welcome to AML classes. What is smurfing and structuring? Smurfing and structuring are two terms commonly used in the context of financial transactions and money laundering. Let me explain each term. Smurfing. Smurfing refers to the practice of breaking down large financial transactions into smaller, less conspicuous transactions to avoid suspicion and detection by authorities. The term smurfing is derived from the cartoon characters called Smurfs, who are small and blue, just like the small transactions that make up the larger whole. The purpose of smurfing is to circumvent the reporting requirements that financial institutions and authorities have in place to track and monitor transactions above a certain threshold. By keeping individual transactions below the reporting limit, typically set by laws and regulations, individuals or criminal organizations can avoid attracting attention and potentially hide the true source or purpose of the funds. For example, instead of transferring $50,000 in a bank account, a Smurf might transfer $5,000 in 10 different accounts over a period of time to avoid scrutiny. The funds are eventually consolidated or transferred to the intended recipient, thereby disguising the source of the money. Smurfing is considered illegal in many jurisdictions because it enables money laundering and other illicit activities. It can involve splitting funds into multiple deposits or transfers, using multiple accounts, involving multiple individuals, or conducting transactions through different geographic locations or financial institutions. Structuring. Structuring is a practice similar to smurfing but with a specific focus on avoiding reporting requirements related to cash transactions. Financial institutions are required to report cash deposits or withdrawals above a certain threshold to the authorities to prevent money laundering and other illegal activities. In the context of structuring, individuals or entities deliberately conduct multiple cash transactions in amounts below the reporting threshold to avoid detection. By splitting large cash transactions into smaller ones, they try to circumvent the reporting requirement. The underlying goal is to make the transactions appear legitimate, even though they are intentionally structured to avoid scrutiny. In summary, smurfing is a broader term that encompasses various methods to conceal illicit funds, whereas structuring is a specific method used to avoid reporting requirements by conducting multiple cash transactions below the threshold. It's important to note that both smurfing and structuring are illegal activities used in money laundering schemes. Governments and financial institutions have implemented strict regulations and monitoring systems to detect and prevent such activities, aiming to safeguard the integrity of the financial system and combat illicit financial flows. Thanks for watching.